I want to talk about a story that's getting a whole lot of attention lately, namely quant funds looking to be falling out of favor with a lot of investors out there. Once seen as cutting edge, using complicated computer models to invest, they now have seen a downturn since, of course, 2007 and more hardship since the financial meltdown in 2008. How about this? Total assets in quant funds have fallen 61% to $467 billion, and 1 in 4 quant hedge funds have closed up shop completely since 2007. So we're asking, what does the future hold for these complicated investment models, and are they getting a bit of a bad rap right now? Here to discuss, Maggie Stumpp, CIO of Quantitative Management Associates, Irene Aldridge, Managing Partner with Able Alpha Trading. Maggie, I guess I'll start with you. A lot of people out there are just truly scared of these quant funds. Can you just sort of distinguish between the different groups of them and tell us which ones are doing okay right now?
Sure. There's a whole family of quant funds that's not just one approach. Some quant funds use mathematical techniques to try to pick stocks. Some try to make their money in, say, the bond market and use techniques to port that money into the stock market. Others use fundamental analysts but use quantitative approaches to put together portfolios. And finally, there's perhaps the most common strategy, which is using factors and trying to identify individual stocks that people think are going to work.
Well, Irene, how bad has it gotten? I gave those statistics. Is there a humility in the sector now? I mean, talk about how beat up the whole industry is.
Yes, well, it's absolutely true. It's a pleasure to be here. But if we look at actual statistics of how quant funds have performed, say, year to date in 2010, quant funds actually outperform a lot of funds out there, and we're talking about discretionary managed funds and equities or commodities or you name it. Quant funds are up there in performance, and obviously a lot of funds have outperformed S&P 500 this year. So, I completely agree with Dr. Stumpp that there are different quant strategies, but all of these quant strategies are, on average, doing very, very well. And these charts were based on data compiled by Global and Private Bank.
Can people trust them more than they thought they could before? I mean, that's a key question. A lot of people are sitting at home saying, I've never even gotten close to the space. Right. They want to trust it, then they want to be able to do some due diligence on it. How can they do that? Well,
I think the main issue here, quant funds, quant strategies are often difficult to understand for mainstream individuals. Like, as Dr. Stumpp, I'm sure will agree, a lot of quant strategies require very sophisticated knowledge and very sophisticated training. We're talking about PhD level training just to figure out how these components fit together. And I think a lot of investors in the current climate of uncertainty are shying away from these opaque models, if you will, or black boxes, because simply, there's a lot of turbulence in the market, and it's not clear what's going on. And the last thing they want to do is add more to the uncertainty. But I think that they will all straighten out, and the performance will show itself.
Maggie, I'll ask my last skeptical question, and then I'll get to some of the positives and where can people look. But if these quant funds are tweaking their formulas, trying to figure out what's the best way to move forward, why would anyone want to go near something that's experimenting right now?
Well, that's a great question. I do think that, quants, you're not buying a model. That's the important thing. What you do when you invest with a quant strategy is invest with a bunch of smart folk. And, the folks that put together these models in the first place, that are kind of models that outperformed in 2002, 2003, 2004, 2005, 2006, have always been tweaking their models. Well, the danger, however, is when these strategies sort of completely change their stripes. They go from a low-risk strategy to a high-risk strategy, or throw out the baby with the bathwater. Then you do have a risk.
Irene, where can people go? What are some names that they can do some research on here if they want to take a plunge?
Well, I have a book coming out on quant. It's called the Quant Investor Almanac 2011, which basically boils down some new quantitative strategies that have come out in the last 3-5 years, that and they're explained in a very simple language to individual investors. But also, I think most strategies are based on academic research. So there are academics that are working with it, and then people translate it into actual trading strategies.
I don't mean to interrupt, though, and either one of you can take it, but I guess a lot of our conversation has been pretty broad, right? Very generic, and we're looking at the whole segment. But what about some specific names that people can look at, or even funds that people can see that might be worth just taking a peek at? So if people want to get more specific, they can.
Well, a lot of the funds are releasing their performance on the need-to-know basis, essentially, right? So there are strict SEC regulations that prohibit hedge funds from advertising their performance publicly. So it's really, the burden is on investors to do their due diligence and do their homework and figure out who is better and who is to separate the wheat from the chaff. And it is difficult in this climate, and we have seen over the last several years, the tide came out and some folks were swimming naked. And I think these are the 25% of quant hedge fund managers that have gone out of business. And the market seems so far is stable in its range, and it's really range bound. We're seeing range bound movement, and it's not clear whether there are going to be prolonged periods of rise again in the next 12 months or so. So there's a lot of uncertainty going on, but it's really up for individual investors to figure out who is worth investing with, and it's a difficult task.
Maggie, have the tweaking of the formulas, I mean, did they get too rattled? Are they maybe making too many changes? And what are the shifts that are going to make these guys geniuses once again?
Well, they're still smart folks, and if you meet some of these people, they're pretty impressive. I think that the first generation of quant models, which maybe a decade ago, where all stocks have to jump through the same loops, they have to be cheap, they have to have upward moving momentum, etc. The second generation started to look at what I'd call contingent models, models that were saying, okay, if it's an airline stock, there's certain ways we would expect airline stocks to behave. The third generation of models is now being a little bit more flexible with the factors, and what people are looking at are certain market conditions where certain factors are more important than others. Obviously, at the bottom of the crisis, value stocks went on a huge tear. And so the important thing would be to emphasize value when things look like they're in crisis. Those kinds of more dynamic, more contingent types of models seem to be the third generation.
All right, Irene, Maggie, thank you very much.